What many investors may be overlooking in the current market environment is that the recent nearly 8% move in Supermicro stock does not appear to be a random fluctuation or a temporary rebound. The price action instead reflects what increasingly resembles institutional repositioning. Large-scale block trades have been consistently appearing in trading activity, suggesting that professional capital may be anticipating a resolution to the company's internal audit and governance challenges sooner than the broader retail market expects. Over the past several months, the prevailing market narrative surrounding Supermicro shifted sharply towards skepticism. Following the company's meteoric rise in earlier periods, concerns emerged regarding accounting practices and the long-term sustainability of profit margins. As a result, many investors began interpreting the company's low double-digit price-to-earnings ratio as evidence that the stock was discounted for structural reasons rather than opportunity. However, underlying industry dynamics suggest that conditions may be evolving. While companies such as NVIDIA and Apple continue to dominate headlines through chip innovation and consumer hardware, the infrastructure required to deploy those technologies operates further down the value chain. Supermicro has quietly positioned itself as a primary rack-scale integrator supporting the next wave of large-scale hardware deployments. The liquid-cooled, high-density server racks that house advanced AI chips represent a critical layer of the ecosystem, and this is an area where the company maintains a meaningful competitive lead. Market participants are beginning to recognize that demand for AI hardware has not weakened. Instead, it is transitioning into a phase where execution at scale determines contract winners. Retail trading platforms such as Robinhood or SoFi Invest often highlight the volatility associated with this ticker, and the stock has become popular among short-term traders seeking rapid price swings. However, institutional data presents a different picture. The stock's behavior has started to diverge from the broader movements of the Magnificent Seven technology names. Whereas Tesla may react primarily to automotive delivery metrics or developments tied to autonomous driving expectations. Supermicro's price movements are increasingly tied to data center capital expenditure cycles. This decoupling typically signals an asset transitioning toward maturity within its industry framework. Despite ongoing noise generated by short seller commentary, forward revenue projections for fiscal year 2026 remain substantial, with targets still approaching the $40 billion level. Understanding the mechanics behind the recent move further reinforces this perspective. A significant surge in trading volume appeared around midday, a pattern commonly associated with institutional accumulation. When a stock gaps higher and successfully maintains those gains through the afternoon session, it often indicates conviction among buyers establishing positions aligned with a multi-month recovery outlook rather than short-term speculation. From a technical standpoint, the $35 price level has emerged as a critical threshold. This area has effectively served as resistance for bearish positioning. A sustained close above that level could force short covering activity and potentially push the stock back into the $40 range, aligning with current median analyst price targets. To fully understand the importance of recent price action, it is necessary to examine the company's operating model. Supermicro is not simply assembling servers. Its strategy revolves around what management describes as a building block architecture. Instead of redesigning systems whenever a new generation of chips enters the market, modular components allow the company to deliver updated server solutions months faster than competitors, such as Dell or HP. This speed-to-market advantage played a central role during the early stages of the AI expansion cycle. However, that same rapid scaling introduced financial pressure over the past 6 months. Meeting surging demand required significant investment in inventory, which placed strain on cash flow. The company's most recent quarterly report reflected this tension. Net sales reached $122.7 billion, representing a dramatic increase compared with approximately $5 billion generated a year earlier. At the same time, gross margins declined to roughly 6.3%. The market had anticipated both strong growth and expanding profitability. Instead, the company delivered exceptional revenue expansion accompanied by temporary margin compression. This margin dynamic remains at the center of the current bull versus bear debate. Automated portfolio systems or robo-advisory strategies may overlook these operational nuances, but active investors closely monitor whether the company can scale back toward double-digit margins. Management maintains that improvement should occur as adoption of direct liquid cooling, or DLC, accelerates. While liquid cooling systems carry higher installation costs, they reduce long-term operating expenses for data center operators. As revenue increasingly shifts toward these higher complexity deployments, margins are expected to gradually recover. Competitive conditions are also evolving. Traditional hardware vendors are beginning to intensify their focus on AI server opportunities. Yet Supermicro's manufacturing presence in Taiwan, alongside expansion efforts in Malaysia, is intended to preserve pricing advantages while maintaining first-to-market execution. The company is also participating deeply in upcoming Vera Rubin and Blackwell deployment cycles with industry partners, reinforcing its integration within the broader AI infrastructure ecosystem. For investors holding semiconductor-focused ETFs or diversified technology exposure through platforms such as Fidelity Investments, participation in this ecosystem may already exist indirectly. Supermicro effectively functions as foundational infrastructure within the AI economy. Advanced chips alone cannot operate efficiently without thermal management systems and rack-scale architecture capable of supporting them at scale. Looking ahead through the remainder of 2026, several catalysts stand out. The first is confirmation from auditors and the successful filing of delayed financial statements, which would represent a significant de-risking event. The second involves clear evidence that liquid cooling shipments are becoming a larger portion of overall revenue. Even modest gross margin improvement of 1 to 2 percentage points in future updates could materially shift investor perception and support a valuation re-rating. Technically, the stock appears to have spent recent months forming what market analysts describe as a rounding bottom or base-building phase. After extended declines, equities often require prolonged consolidation to remove weak positioning from the market. Recent trading volume suggests that this process may be nearing completion, supported by the emergence of higher lows on the daily chart and momentum indicators such as RSI moving out of oversold territory. Risks nevertheless remain. Broader macroeconomic factors, particularly interest rate fluctuations, can influence financing costs tied to the company's inventory expansion and debt structure. Investors managing retirement accounts or diversified portfolios must therefore remain attentive to position sizing. This remains a high-beta technology exposure rather than a traditional defensive holding. At current levels near $33.58 compared with an analyst consensus around $43, the valuation gap represents notable potential upside relative to many areas of the technology sector, provided execution improves as anticipated. In summary, market expectations surrounding Supermicro Computer have largely centered on concerns related to accounting uncertainty and margin pressure. Yet recent trading behavior and sustained revenue expansion indicate that the company continues to occupy a critical role within the global AI infrastructure buildout. Hardware shipment volume within its niche remains exceptionally strong, and operational speed continues to differentiate the business. If margin compression ultimately proves to represent a cyclical trough and the company successfully executes its liquid cooling roadmap, the second half of 2026 could present a markedly different outlook for shareholders. The stock now appears to be transitioning from a speculative momentum-driven trade toward a large-scale industrial technology participant tied directly to data center expansion. The $35 resistance level remains the key marker to monitor as the company continues its ongoing effort to rebuild market credibility, while institutional interest steadily re-enters the narrative.